Most people carry a little plastic card in their pocket every single day, but they have no idea what it's actually doing, and it's costing them thousands. Caveman discovered credit cards, and what Caveman found changed everything. There are 7 things happening every time that card gets swiped. Most people only know about 2 of them. Number 1. The credit card is a rock on loan. Okay, Caveman, explain. Long ago, Caveman used shiny gold ores to buy things. Want mammoth meat? Give gold ore. Want warm fur? Give gold ore. Simple. Caveman likes simple. But then one day, Caveman run out of gold ores. Mammoth meat's still there. Caveman's still hungry, but wallet empty. That is where credit card come in. A credit card is not Caveman's gold ore. It is a gold ore that Caveman borrowed from a very large, very serious tribe called a bank. Caveman get to use that borrowed gold ore right now, but Caveman must pay it back later. According to Capital One, a credit card lets someone use a line of credit to borrow money for purchases. The purchase amount is owed back to the card issuer, the bank or company that gave out the card. So every time that card gets swiped, it is not the cardholder's money being spent. It is the bank's money. The cardholder is just promising to pay it back. Caveman find this very stressful, but also very useful. Here is the part most people miss though. A credit card is what is called revolving credit. That means someone can borrow, pay it back, and borrow again, over and over, without having to apply for a new card every time. As long as the balance stays below the credit limit, the card keeps working. Think of it like a bucket of borrowed gold ores. Spend some, put some back, spend again. The bucket refills every time a payment is made. But here is the part Caveman did not understand at first. And this is important. The bank is not giving those gold ores out of kindness. The bank wants something back. And what they want is called interest. More on that very soon. Number 2. The credit limit is the size of Caveman's bucket. So the bank loans gold ores, but not unlimited gold ores. Every credit card comes with a credit limit. That is the maximum amount that can be borrowed at one time. Go above that limit, the card gets declined. Sometimes there is even a fee. According to Chase, the credit limit is set by the card issuer based on things like income and credit history. The better the credit history, meaning the better someone has been at paying back borrowed money in the past, the higher the limit is likely to be. Caveman had no credit history. Caveman had to start small. But here is something interesting. The credit limit is not just one number to worry about. There is also something called credit utilization. That is how much of the available limit is being used at any given time. If Caveman's credit limit is 1,000 gold ores and Caveman has spent 900 of them, Caveman is at 90% utilization. Financial experts generally suggest keeping that number below 30%. Why? Because a high utilization rate can actually hurt something called a credit score, which is Caveman's trustworthiness rating with all the serious money tribes. Using the whole bucket makes Caveman look desperate, and nobody loans gold ores to someone who looks desperate. So the credit limit is the bucket, but the smart move is to only fill that bucket part way. Number 3. The swipe is way more complicated than it looks. Caveman thought swiping the card was simple. Caveman was wrong. Every single credit card transaction involves multiple groups working together in seconds. According to Discover, here is what actually happens the moment a card gets swiped or tapped. First, the merchant's payment machine sends the transaction info to the payment processor, sometimes called an acquirer. Then the processor sends that info to the payment network. Networks are companies like Visa, MasterCard, American Express, and Discover. The payment network then asks the card issuer, the bank, to approve or deny the transaction. The card issuer checks the account to make sure there is available credit and that the card is in good standing. Then the issuer sends the decision back through the same chain. The whole thing happens in about 2 seconds. 2 seconds! Caveman impressed! But here is the part most people never think about. The merchant does not actually get their money instantly. The card issuer pays the merchant, but then the cardholder owes the issuer. There is a whole system of money moving back and forth behind the scenes, and everyone in that chain takes a small cut. That is part of why merchants sometimes charge a little extra for credit card payments, or why some small shops prefer cash. The networks and banks all collect a fee from the merchant for every transaction. Those fees typically range from around 1.5% to 3.5% per transaction, according to most major payment processors. Every swipe is a whole operation. Caveman had no idea. Number 4. Interest is the trap, and it is a big one. This is the most important thing. Caveman must pay close attention here. If the full balance gets paid off every month by the due date, no interest is charged. 0. The money is borrowed, used, and paid back, and the whole thing is free. But if the full balance is not paid off, that is when the bank starts charging interest. Interest on a credit card is measured by something called APR, annual percentage rate. According to the Federal Reserve's data, the average APR for all credit card accounts was around 20.97% as of November 2025. For accounts that were actually carrying a balance and being charged interest, the average was 22.30%. That is, a lot of gold ores going back to the bank. Here is what that actually looks like in real life. According to Bankrate, if someone has a $5,000 balance on a credit card with a 20% APR and only makes the minimum payment each month, it could take around 23 years to pay off, and they would end up paying about $7,723 in interest on top of that original $5,000. 23 years! More than twice the amount borrowed. Paid back in tiny minimum payments while interest piles up every single day. Because here is the part that makes Caveman's head hurt. Interest does not just pile up once a month. According to Bankrate, the bank applies a daily interest rate to the balance, which is the APR divided by 365. So even sitting still, a balance gets more expensive every single day it stays unpaid. Minimum payments are not the path out. They are the path to staying stuck. The smart move, and the move that keeps the credit card from becoming a trap, is to pay the full balance before the due date each month. Do that, and the interest never touches anything. Number 5, the grace period is a hidden gift. But wait, there is actually some good news here. Most credit cards come with something called a grace period. This is the time between when a statement closes and when the payment is actually due. According to Discover, this grace period is typically at least 21 days. So when a purchase is made on the first day of the billing cycle, and the statement closes 30 days later, and the payment is due 21 days after that, that purchase can sit for about 51 days before interest kicks in. And if the full balance is paid before the due date, no interest ever gets charged. That is essentially a short-term, interest-free loan every single month. Caveman finds this very clever. Like borrowing a neighbor's spear for a mammoth hunt and giving it back before the neighbor even notices it was gone. But there is a catch, and there always is a catch. The grace period only applies to regular purchases. According to Discover, if a cash advance is taken, meaning cash is withdrawn from the credit card, interest usually starts accruing immediately from that day, with no grace period. Cash advance APRs are also often higher than regular purchase APRs. So the grace period is a gift, but it only stays a gift if the balance gets paid in full. Number 6. Credit cards are building a score in the background. Here is something Caveman did not fully understand for a long time. Using a credit card is not just about buying things. Every payment, or missed payment, is being reported to 3 major credit bureaus: Equifax, Experian, and TransUnion. According to U.S. Bank, the card issuer reports each monthly payment made to these 3 agencies. Those reports build a credit score. A credit score is basically a trustworthiness rating. It is a number, typically ranging from 300 to 850, that tells banks and lenders how likely someone is to pay back money they borrow. The higher the score, the more trustworthy the person looks. The lower the score, the harder it is to borrow money, and the more expensive it gets when borrowing is possible. According to Experian, making on-time monthly payments and keeping debt under control will typically result in a higher credit score over time. And that score matters far beyond just credit cards. It can affect whether someone qualifies for a car loan, a home mortgage, and even some rental apartments. Caveman did not understand why future Caveman's problems were related to today's credit card bill. But they are. Every time the bill gets paid on time, credit score goes up. Every time a payment is missed or is late, credit score takes a hit. Every time too much of the credit limit is used, score can dip. The credit card is not just a spending tool. It is a test that runs constantly, every single month. And the score from that test follows everywhere. Number 7. Not all credit cards are the same. Rock. Caveman learned this one the hard way. There are many different types of credit cards, and choosing the wrong one can mean paying fees or missing out on rewards that were already being earned anyway. According to Yale's financial literacy program, the most common types include rewards cards. These give something back for every purchase. That could be cash back, points, or travel miles. The idea is that spending that would happen anyway, groceries, gas, bills, earn something in return. Low-interest cards. These cards prioritize having a lower APR over offering rewards. For someone who sometimes carries a balance and pays interest, a lower rate can save real money even if the rewards are smaller. Student cards. Designed for people who are newer to credit and are building a credit history for the first time. These often have lower credit limits and fewer perks, but they are easier to qualify for. Secured cards. These require a cash deposit up front, which becomes the credit limit. According to Experian, secured cards are generally for people who are new to credit or working to rebuild it after some problems. If the account is handled responsibly, the deposit is eventually returned. The thing about credit cards is that the right card depends entirely on the person's habits. Someone who pays their balance in full every month and spends a lot on groceries and gas might do really well with a high rewards card. Someone who sometimes carries a balance month to month might be better off with the lowest APR possible to reduce what interest costs. Caveman needed rewards card for mammoth points. Caveman eventually figured this out. And there is one more thing worth knowing. Many cards charge an annual fee just for having them. According to Wallet Hub data, the average credit card annual fee is around $27.85 as of Q4 2025, though premium travel cards can charge several $100s per year. Whether an annual fee is worth it depends on whether the rewards and benefits earned actually exceed what the fee costs. Sometimes they do. Sometimes they do not. Worth checking. Borrowed gold ore. Credit limit. 2-second swipe chain. 21% interest that grows every day. Grace period that saves money if the balance gets paid in full. A credit score being built in the background. And the right card depends on the habits. Americans carry over $1.27 trillion in credit card debt as of Q4 2025. That is a lot of unpaid borrowed gold ores. Knowing the rules changes that. Caveman know the rules now. With that said, Caveman see you on the next video.